Good morning and welcome to our autumn statement event. My name's Mark Proctor. I'm Senior Partner for Lovewell Blake, and our speakers Colin Fish and Mary Schofield will guide you through the key tax aspects from the budget announcement yesterday. There will be time after the presentations for questions and answers, so please use the Q&A chat function, which should be towards the bottom of your screens. We're pleased to be partnered with the EDP and to have Richard Porritt, the editor of the EDP and Norwich Evening News, with us this morning. Thank you, Richard, and your team. Richard will be chairing the questions and answers at the end of the presentation. The autumn statement set out the government's priorities of stability, growth and public services. So far, markets seem to have reacted calmly to the statement, suggesting much of the content was in line with expectations. Growth was a key theme within the statement yesterday, although I'm not entirely sure there was much in the statement that will have delivered much to boost business confidence or provide tax incentives to encourage business growth. So time will tell on that one. There was, of course, a lot of acknowledgement of the need to increase tax revenues and reduce government spending in some areas to get us through this challenging period of time. There was confirmation that state pension and certain benefits will increase with inflation at 10.1% from next April, and commitments on cost of living support payments, business rates, support with energy costs, energy efficiency, increases in funding for health and social care and education. While we won't necessarily be focused on those areas this morning, we will of course focus on the key income and corporation tax changes for individuals and businesses. I'll now hand over to Richard.
Thank you, Mark, and welcome again to Lovewell Blake's Autumn Statement webinar. It's early, so thanks for joining us. I'm sure it's going to be a smashing hour or so. Squeezed, screams the EDP this morning, and the Nationals are even crueler, frankly. Carnage, the middle class soap, says the Daily Mail, and even one said, well, folks, at least we've got the football to look forward to, although that'll only probably be for a couple of weeks if you follow England. Here's the headlines politically, guys. We're in recession and it's going to be a long one. Politically, this party needs stability. The government desperately needs it, of course. As you said, Mark, the markets seem to have reacted fairly calmly. But will it be enough? Well, maybe. But blimey, it's going to hurt, isn't it? Jolly, hey? Well, happy Friday. Now, I'd like to hand over to Colin Fish, tax partner. Remember, questions down the bottom. Colin, take it away.
Right, thank you, Richard. So I think the first thing I would say that is probably the last 2 months have been one of the most eventful periods I've ever had doing the job I do, which has been quite a lot of years in terms of tax announcements. We've had too many budgets in that period. We've had a number of other statements. We've had measures introduced, measures withdrawn, and it's actually been quite hard to keep track of everything. So one of the things I want to do in this short talk is just flag up where we are at the moment, what came in yesterday, and what is actually retained of some of the changes that have been since the last budget in March. So if I move without further ado onto the first slide, on this, I've summarised some of the key changes that were announced yesterday. So what we can see, and I'll sort of dig in a bit more to these shortly. We've seen the thresholds being frozen. Now, they were frozen already, but they're being frozen for a longer period. It was going to 2026, and it's now going to 2028. We've seen a reduction in the threshold of where the 45% tax rate comes in. And that now applies from a level of £125,140, which is a very precise number, and I will explain the significance of that number in a moment. We've got the reduction in the dividend allowance from £2,000 to £1,000 from next April, and it goes down further in April 24 to just £500. We've got a reduction in the capital gains tax exempt amount, so that's going down from its current £12,300 to £6,000 next April, and dropping again in April 24 to just £3,000. And we've finally got a further freezing of all the inheritance tax bands, which were frozen to 26, And we need to remember that actually they haven't moved since, I think it's something like 2009, they came in at that level. So it's a very long sort of freeze period, nearly 20 years effectively. And that is now running to 2028. In terms of some of the other changes, and these are ones that were announced, some of these in the September budget, some withdrawn, but what we're basically left with is there's the 1.25% increase. Now that was announced last March, but that got reversed in September, and that reversal is staying, so that should disappear from this month effectively. There was a temporary increase of 1.25%, and that was going to be converted to the health and social care levy, also 1.25%, so that's gone. But the 1.25% increase in dividends that was put through at the same time, that was going to go, but then that going has got reversed, so that is basically going to stay. So we keep the 1.25% increase in the dividend tax rate. In the September mini budget, stamp duty thresholds also increased, and whilst those are staying, they're now time limited. So they run to the end of March 25, and then from April we'll go back to old rates, or something else will be announced. And the other thing that's around is last March it was announced that from 2024 the basic rate of income tax would drop to 19%. Then in September that was going to be accelerated and happen more quickly, but now it's been announced that that won't happen at all, or until we can afford it as a country, which will be a few years' time effectively. So basic rate stays at 20%. If we have a look now at the effect of some of these allowance changes, so basically the personal allowance and the high rate threshold are going to stay frozen until 2028, which is a further 2 years. Now, and these measures, they always seem quite innocuous because it's just a rate freeze and no one really notices them. But I did a quick calculation of an example of someone, for example, on £50,000 worth of salary now, pretty much the top of the basic rate band, and they would lose something like 15% of their total income in income tax. Just look at income tax here, not national insurance. If they then got pay rises every year at say 5%, and if inflation, cost of living, if that all increased by 5% a year up to 2028, their income would increase to about 63,000. And because such a big proportion would then be in the 40% band, their overall tax as a proportion of their income goes up to 20% of their income. So there really is quite a big effect if you're at certain income levels, when you sort of drag with the effects of inflation into the higher rates effect, it does have quite a big effect. The other point is around dividends and that rate not going down. And that does raise a bit of a question, because historically we've always had the issue that if you take money from a company, there may be a certain proportion of what you take which you can take as either dividend or salaries as a business owner. And what has historically been the case is that dividends have always been cheaper. There used to be quite a big gap. The gap's been whittled down with dividend rate increases. And we're now at a position where actually at certain levels, it's actually cheaper having salary. That's only the case pretty much if you've used up all your sort of higher employee national insurance contribution level, if you've got that level anyway, so only at high levels of income. But it's very much worth actually doing the calculation if you've got an option on how you take money from the company. I've just done a slide on the tax bands now, as will apply from next April. So we basically have a range of rates. So we've got 0% for those who have income of less than 100,000. You get a personal allowance effectively where there's no tax. You then got a 20% band. There's then a 40% band, but with a 40% band, there is sometimes a high marginal rate in there if you're in receipt of child benefit, and that gets clawed back once you go over effectively the 50,000. So you get a high marginal rate for a bit until that is clawed back. once you get to 100,000 of income, there's then a clawing back of the personal allowance. So for every £2 you go over 100,000, you lose £1 of your personal allowance. And that's the significance of the 125, 140, because that by that stage, you're £25,140 over the 100,000, and therefore, because you're losing half of that, that effectively eliminates the 12,570. And the effective tax rate, the amount of extra tax you effectively pay, is approximately a 60% rate in that band. So it's quite an expensive band. It used to then drop down to 40% for a bit, but it now goes straight to 45%. And the effect of moving the limit down from 150 down to the 125 is going to be 5% on about 25,000. So it will cost those earning more than 150,000, it will cost them about £1,200. So in terms of a few general comments on the change, the one thing we are going to see, and one of the main reasons for having these dividend allowances, for example, which is the amount of dividends you can receive without paying tax, is as that rate falls, we're going to see more and more people who will need to submit tax returns. So at the moment, with the level at £2,000, a lot of people won't have that level of dividends. But as it drops, more will fall into it. And we're also going to have the situation that more people will be into capital gains tax with gains levels of £3,000. So there's going to be more need for compliance as the rates fall, more self-assessment returns that need doing. It does mean that things like ISAs will become increasingly beneficial because they will take you out of it. I think in the past, some people haven't always bothered with ISAs just simply because there's the dividend allowance, there's a capital gains tax exemption, and for fairly sort of low sort of amounts of investment, it doesn't make a huge difference, but it will start making much more of a difference going forward. I think the other thing is if you've got a portfolio of shares, it may be worth just planning over the next year or two as the rate drops down, the exemption drops down, and planning for actually making sure you use up your limit exemptions effectively, because it may be quite small share sales will attract capital gains tax in a couple of years' time, whereas you could maybe dispose of shares now. So it's really just worth having a plan for the next couple of years. Complete change of topic. I want to move just to have a quick pick up on electric vehicles. These are now becoming much more mainstream. I remember talking about these sort of 5 or 6 years ago, and they were very much a rarity then. Nowadays, they're much more mainstream and quite a common benefit to be provided by companies. What they basically said is that from 2025, all electric vehicles will have to pay vehicle excise duty. So we're going to see vehicles moving into that. So that's broadly the £165. But in terms of company car tax, there has been a bit of a need for visibility on that because there's quite a long lead time on ordering an electric vehicle. So you really need a bit of forward planning in terms of what rates are going to be. So at the moment, we've got a 2% benefit rate. That's going to go up by 1% in 25-26, and then a further 1% each year until it gets to 5%. I think that's actually hugely encouraging because when you look at the rates on other cars, they go up, as you can see on the next bullet point, they will go up to 37% of list price. So 5% of list price as being the benefit in kind still keeps it as a hugely attractive benefit. And at least we've got visibility for quite a number of years on that. So for a company provided electric car, it's a very good benefit in kind. My final slide is just a couple of almost sort of housekeeping type anti-avoidance points. There's a couple of quite minor points, one on share exchanges. There used to be a rule that effectively a company's shares are effectively sited, located wherever the share register is effectively. So if you swap shares in your UK company with an overseas company, it became you swap your shares for something located abroad. this rules is aimed at non-UK domiciled individuals, and they could claim advantages in terms of having a remittance basis on their income if they could switch the income abroad. So there's a rule on this that if you've got a material shareholding in a company, you do the share swap, then it's still treated as being a UK located shareholding. And the final point is that they have announced that there will be some increased compliance resource for the revenue. That's certainly something that I do see announced pretty much in every budget. There is a sort of a real sort of focus on this by the revenue, and it's something they do regularly announce. And this is aimed at wealthy individuals effectively, where there'll be a bit more of a focus on returns and so on that they put in. And that's everything I had to say. So I will hand back to Richard.
Well, Dr. Schoff, Colin, thank you for that. That's a lot to digest there, but there is a lot in this statement. It did feel more like a budget really than a statement in many ways. There was more, certainly, I was not expecting quite this much, but there's a lot of talk this morning, certainly, and Jeremy Hunt's doing the rounds as we speak, and I've just, while you were speaking, had an eye on it, and there's a lot of talk about stealth taxes. I just wonder if you could maybe delve into that a little bit and just explain it a little bit for us.
Yeah, this is very much the issue about the freezing of allowances. I think people see that if there's no changes in the tax rates, they perceive that everything stays constant. But for anyone whose income is anywhere near the next band up, by the time you factor in a few years worth of inflation, you're suddenly going into maybe a chunk of your income being taxed to say 40%, whereas you're all at maybe 20% now. You don't actually notice it year by year. It's just that you notice gradually the proportion of income going in tax going up slightly on your pay slip, but it's not as overt as just putting up a tax rate.
So potentially, you know, a good move politically. I look at these things through political glasses as well as financial ones. So perhaps a good move, but they're probably not that keen on people like me banging on about it. So we'll see how it plays in the long term. Colin, thanks very much. I'm sure there'll be some questions for you to pick up at the end. Guys, if you want to ask a question down the bottom in the Q&A box is where I'm told you should put it, and those questions are coming in already. There's lots of people on the webinar, so thanks once again for joining us, and do get those questions in. Next up is Mary Schofield, tax partner. Mary, are you there?
I'm here. Thank you very much, Richard. The next thing I'm going to try and do is make sure my slides are here as well. Do the double. You have to tell me if you can see them. We're good?
That's
excellent.
Good, Mary.
Thank you very much, Richard. Lovely. Good. Well, good morning, everybody, and welcome to the business and sort of corporation tax part of this morning's seminar. I'm sure that sort of eagle-eyed amongst you will probably be aware that there wasn't a great deal of announcement yesterday around business and corporate taxes. It was given a fairly light touch. Other than in the sphere of research and development tax credits. So there were some significant changes announced yesterday, which focus on really reining in the SME scheme for corporate taxpayers. I think over recent budgets, the revenue have been toying with how to address fraud and maybe over-enthusiastic claims for research and development. And whilst we have seen some uptick in them policing the system, I think that some of the changes we saw announced yesterday was really just to rein in the very generous tax credits on the SME scheme, such that it might make it less attractive to people trying to claim that tax relief where they're not entitled to. But of course, that does result in collateral damage for genuine businesses who are going to lose out. So let me just take you through what those principal changes are. So as you may recall, there are two very distinct systems for claiming research and development tax credits. There's the RDEC, which is really predominantly aimed at larger corporates, so the Glaxos of this world. But the RDEC also extends itself to SMEs, where that SME may have grant funded, so notifiable state aid funded R&D, so they are still able to claim under the RDEC scheme. So it's still very significant for all our clients. So as the slide suggests, the rate for the RDEC has increased to 20% from previous 13%. So that is good news. That's a tick. But the SME deduction has decreased. So the 130% on top of the 100% spend for a corporate has decreased down to 86%, which is quite a drop. And of even more significance is the drop of the repayable tax credit, which has gone from 14.5p in the pound to 10p. So that will have a big impact on loss-making businesses. So the revenues rationale for introducing these changes is that, and there is some logic to it, that obviously running two different systems concurrently is expensive and complex to administer. So having one straightforward scheme might make some sense. So I think that we can really watch this space, because there's a consultation is being announced, so that we can probably see the schemes at some point down the line being completely amalgamated. So I just wanted to pull up this. This slide really shows us the differential between the current schemes as we sit today before the changes in April 23. So you can see that for an SME, for a tax-paying SME, if they had a sort of £100,000 of expenditure, then the effective tax relief for them is the sort of 43,700. So there's quite a bit of tax relief under the current scheme for an SME, whereas you can see under the RDEC scheme, it's a quarter of that. So. And likewise on the repayable tax credit, that is very generous for SMEs. So basically, 33% of everything you spend is coming back in a tax credit for a loss-making business. Whereas you can see again under the RDEC scheme, it's much less favourable, a third of what you'd get under the SME scheme. So just wanted to sort of highlight how this might look from April 23. So, and I'll touch on this in a second, but it feels, bearing in mind the previous slide, that under the new rules that an SME isn't losing out if it's a taxpayer, because with the hike in the corporation tax rate, you're actually getting more tax relief under the new scheme. But I'll come back to that on the next slide. But you can sort of see that the increase under the RDEC scheme is significant. That's pretty much a 50% increase. And if you go to, but it's the bottom half of this slide where you can really see the impact it's going to have on SMEs, is that repayable tax credit for loss-making SMEs is dropping to, not quite half, but, I think we're really going to see that, okay, fraudulent businesses making those claims are going to make a lot less money, which is really good news. But startup businesses, particularly in the tech sector, who rely on the R&D tax credit in those early days of doing business, it funds future R&D. It's just going to be, it's going to be very, very difficult for them. So I wanted to, and then on this slide, hopefully this kind of sort of summarizes the overall effect of the proposed changes on the R&D scheme. But the one point I did want to pick up on is actually the top line. So profit-making SMEs, it looks like we're getting an uptick because of the change in the rates. but actually built into that is the your actual P&L expenditure of 100,000 is now getting tax relief at 25%, whereas previously it was 19%. But in real terms, in real cash terms, we're actually losing out. So yeah, I think it's still a very generous scheme whilst it lasts. I think we probably need to make the most of it, because I think we can genuinely expect there to be future announcements in future budgets. So my next slide is, I mean, it's old news, it's new news, it's old news. Who knows where we are with the corporation tax rate, but I think we do know where we are with it now. So as is obviously very often publicised about the UK corporation tax rate, it is, you know, currently at 19%. It is the lowest in the G7. No doubt, you know, people sitting in the seminar will have a view as to whether that 19% it does stimulate growth in the UK economy. But the planned CT increase to 25%, which was previously announced in the March 21 budget, and of course as seen has been in and out in that time, will go ahead from April 23. So we'll probably all remember the old rules where we had a sort of a blended rate for companies. So profits in excess of 250,000 taxable at 25%, profits below 50,000 taxed at 19%, so the small profits rate, a blended rate in between. So we're all back now to thinking very carefully, if we've got groups of companies under sort of common control of shareholders, about where our profits sit and making sure our management charges are correctly looked at, such that you know, we don't end up paying tax at highest rates or the marginal rates. My next slide is on capital allowances, which is always generally big news following a budget. We all sort of very eagle-eyed about what the Chancellor might announce. He didn't announce a great deal yesterday. You may recall back earlier in the year, I think it was May time, they announced a bit like a sort of a mini consultation. You know, we were anticipating that the super deduction was going to come to an end, that the annual investment allowance was going to go down to 200,000. So there was a sort of a mini consultation which said, you know, where might this go? What might we do to try and incentivize capital expenditure without costing the sort of UK economy too much in lost tax revenues? Now, obviously, you know, the climate as we know it is tricky. The Chancellor probably didn't have a great deal to play with. He'd already announced, it was already been previously announced, that the annual investment allowance would be permanently set at 1 million. So very little in addition to that was announced yesterday. I mean, the AIA is very generous, and it works quite well for SMEs, because of course you know, that being able to offset £1 million of capex expenditure against your taxable profits in any given accounting period is pretty helpful, and it also puts a cap on those big businesses of what they can claim. The only sort of minor announcement yesterday was the extending the 100% tax relief on electric charging points up to March 25. As we probably all fully expected, the super deduction will come to an end in March 23. So, you know, we never really expected it to be extended if the corporation tax rate was going to increase to 25%. So, but it does, the capital allowances play a big part in planning to mitigate tax in any given accounting period. The fact that we know that the corporation tax rate is going up, I think, makes that every sort of business taxpayer needs to think very carefully about when to incur expenditure, on what type of asset and under what type of contract. So the one thing I would say is it shouldn't necessarily be a race to the finish to see if we can lock into the super deduction between now and March 23. Now, I've obviously prepared a fairly simplistic slide here for us just to look around, you know, if we were to crack on and think, let's lock into the super deduction, is that the best way forward? Because we know that's going to disappear from our grasp. Now, it may be the case that if you have used up all your annual investment allowance, or you're likely to, that the super deduction may still be very much in play for you for the next sort of 3 or 4 months. But if you haven't used up all your annual investment allowance, then you know there's the calculation to be done to see what is most beneficial in terms of your capital allowances policy. And we also have to remember that when you claim tax relief under the super deduction, the possibility exists that when you dispose of that asset, you get proceeds upon which you pay a balancing charge. Whereas when you're dealing with the annual investment allowance, the proceeds are typically pooled. So unless they're very significant, they don't create a distortion or a balancing charge for tax. Now, my next slide is in indirect tax, which is pretty bold, given that you all know I'm not an indirect tax partner, but I'm reliably informed that Rob Geary, our fabulous VAT manager, is on hand should anyone have any questions. But I think the sort of main aspects yesterday, which will interest taxpayers, is the sort of freezing of the registration and deregistration thresholds for VAT. So as you know, Colin alluded to in his talk, that you know inflation is going to sort of creep up on us, and it's going to bring more businesses within the VAT registration threshold. Colin touched on the point to do with vehicle excise duty. There was an announcement yesterday, sort of buried in the detail, and I couldn't find anything specific about import tariffs, but there is going to be a swathe of cuts on some imported goods just to make it easier for UK manufacturers and food producers to make businesses more profitable. And again, something that's pretty much under the radar, was just buried in the detail yesterday, was that there had been talk about there being an online sales tax, but I think you know that has been parked for the current time. And yeah, I think we've got enough going on as a country without introducing probably another tax, so that's likely to have been a good call. And then my final slide, which doesn't want to come up. Yes, this just touches on what Colin mentioned about a budget doesn't go by without HMRC committing to tackle more avoidance and evasion, which is a good thing, and we welcome that. I mean, it feels like a fairly modest investment, 79 million over the next 5 years, given you know the scale and size of the sort of the Treasury and taxpayers in this country, but you know, as long as it's properly administered and targeted against people who are not, you know, not following the rules as they should, then that's welcome. And I think that's my talk done. Thank you very much.
Thank you, Mary. That was fantastic. I've got a few questions before we go to the actual questions on that. There's a few things I sort of scribbled down here. You said right at the top that you thought it was more about reining in generous tax relief, but quite a lot of SMEs we've been speaking to, and also that I've heard on other media, are not over the moon, should we say, about what was released yesterday. Are you suggesting that actually it could have been worse, do you think?
Well, I'm probably suggesting it could get a lot worse. I think it was I think it is not a knee-jerk reaction, but I think it met a lot of goals. It's going to mean that the revenue have got to be less disciplined about tackling fraud because the numbers have got smaller. You know, we've obviously got a lot less money as an economy, so it reins that in, doesn't it? So, but yeah, I think it will be crippling for a lot of startup technology businesses who for the first 4 or 5 years are very dependent on that R&D tax credit. Yeah, I think it's incredibly disappointing.
And on the R&D as well, You seem to kind of hint, rather worryingly, you thought that the scheme in its current form, its sort of days are numbered.
Yeah, I think they are. I think that there's going to be a composite scheme. I mean, that's almost exactly what the revenue are telling us. There will just be one R&D scheme. Now, you know, if you can imagine that the very biggest pharmaceutical corporates are going to be claiming under that scheme, I don't see how that can be as generous as it currently is. That's just my pure speculation. But I just think giving, you know, even giving 10p in the pound back on a corporation tax loss, you know, it just would cost the Exchequer a lot of money.
Yeah, quite. Okay, well, let's get to some questions. If you've got any questions, please do put them in the chat. We'll try and get to them. If we don't get to them, then we'll pass them on. But we have got a couple that we can kick off with. So I'll just sort of throw them out there and see who wants them, I guess. So Callum Howard, who is right in there at 4 minutes past 8. He's determined. He wanted to get this answered. We hadn't even started. So I think I was still rambling on at that point. But he was he wanted to get in there nice and quick. So Callum writes, what can startups do to minimise our exposure to increased cost and thrive in a recession? And we think this is going to be, hopefully, I guess, this sounds like we're hopefully shallow and long, rather than like that, I think. Well, there you go, Callum. A really full and frank answer from the panelist. You must be delighted that you got up so early.
Do you want to grab that one, Mary? Or?
Yes, I mean, you know, in terms of how we, you know, as taxpayers and businesses, you know, I guess protect ourselves from, you know, inflationary rises and, you know, I mean, cost control is absolutely key for businesses, and I think a lot of things that, you know, we do as certainly as partners and managers at Lovewell Blake is, you know, we are, you know, very, very robust with our clients about reviewing their annual expenditure and making sure that, you know, we're all as lean as we can be, because ultimately not understanding your numbers and not managing costs leads to sort of tricky outcomes. So, you know, we help our clients with that every day, and things that people think were pivotal and fundamental to their business can sometimes be knocked out. Obviously not your accountant costs, of course.
Obviously. All right, this is a very mysterious one that's come in. This is from anonymous attendee. I don't know why the mystery, why the cloak and dagger stuff. But the question is, are there any changes to entrepreneur relief in the update? So I'm guessing it's someone famous, maybe Elon Musk or Richard Branson or something, trying to keep it on the down low. But anonymous attendee, that is. So I'll answer it. I'll ask it again. Are there any changes to entrepreneur relief in the update?
Yeah, shall I pick that one up? Entrepreneurs relief is the capital gains tax relief. That means you pay 10% rate. It got trimmed down from 10 million to £1 million worth of maximum relief about 3 or 4 years ago. And it got renamed business asset disposal relief, but it still does exist. There weren't any recent changes, and we haven't seen any changes in the recent budget to capital gains tax rates generally. It's just purely that exemption, and the effect of the exemption will be an extra £2,500 for taxpayers over the next couple of years, but all the rates are staying the same.
Oh, he's back, anonymous attendee. I understand there was a large increase in fuel duty flagged in the documentation, albeit not mentioned. Is this likely to go ahead? This will have a big impact on all business costs and put big upward pressure on salary asks from staff. That's a really good question, actually. So I'll go again. He understands there was being sexist there, increase in fuel duty flagged in the documentation, albeit not mentioned. Is that something that you guys have spotted? We're still going through the detail on this. Did anyone spot that large increase on fuel duty?
Yeah, I did pick up, there was mention. This is almost this routine one that does come in, and I think would take effect in the spring. the likelihood is that it will get reversed, I suspect, or at least reduced, because they haven't moved fuel duty for some time. It wasn't mentioned, but it doesn't mean that there is an intention from government to keep it effectively. I suspect there'll be an announcement as we get nearer the date for it coming in.
I think just on that, just while you're speaking, I'm just looking on my phone on the news feed. I think that has been mentioned to Jeremy Hunt, and he seems to suggest that the OBR are being slightly presumptuous that it could happen, it might happen, but it's not currently government policy, so it's not off the table, but it's not in the autumn statement, I believe. But there we go. We'll maybe find more on that. I was wondering as well, who are the biggest losers in this? I mean, maybe we could look at that on two levels. Maybe, you know, what sort of business is the biggest loser, and for personal allowances as well, who are the biggest losers? Because they certainly want us to think that it's the most wealthy, because that's the moving it from 150 to 125 where it kicks in. But it seems to be playing out. Certainly, Fleet Street and even Prospect House seem to be suggesting that it is the middle class. So maybe we'll do that in two bits. What sort of businesses should be most annoyed by this, do you think? Who are the most vulnerable to anyone?
Well, okay, thanks, Richard. I mean, just to the corporation tax rate increase to 25%, is significant. We can't. We know we've got to balance the books, but a hike from 19% to 25% across the board for all corporates, other than the very smallest, is, all businesses are going to feel that pinch. We've got very, very used to a low corporation tax rate, so that in itself is going to, influence decisions, given that, everything's tighter for businesses as it is. And secondly, I just come back to this point on the R&D. We are supposed to be an entrepreneurial country, stimulating, startups, fintech, agritech, edtech. These are the businesses that we are, our flagship startups that are just going to suffer because of the R&D changes. So that's how I feel about it.
And can anyone pick up the sort of personal tax bit? Who do we think are when it comes to personal tax, who do we think are the biggest?
Yeah, I think the answer. Well, I think the answer is everyone is going to lose a bit because of this freezing of allowances. I think if in 2028 you just got inflationary pay rises, you divided your tax by your income, you would find your rate of tax had gone up at whatever level, because you are moving, even if you're a basic rate taxpayer, you've got more tax than personal allowance covered effectively. I suspect the biggest losers will be the people around about 150,000, because you've got that effect, plus you've also got the extra 5% bit on the other 25,000. So I suspect there'll be probably a bigger proportion at that level, but everyone is going to lose a bit effectively. Yeah.
Okay. Another question has come in. Could this have been worse? VAT was not increased and CGT rates were kept low. And might there be more pain to come? It's very jolly, isn't it? Feels like a Friday, not long before Christmas, doesn't it?
Yeah, my suspicion is it probably won't get worse. There is actually a huge amount of tax when you actually look at the amounts each of these bits raises effectively. It is huge amounts, and if the economy does a bit better than is predicted effectively, then I think some of the freezing of rates and allowances will actually be unfrozen later. We might see corporation tax rates and so on going down a bit. So my suspicion is there probably isn't worse to come. There might be better, but we're probably going to have to wait 2-3 years before we see the better.
Yeah, quite. This is a really good question, actually, and in preparation for this, we spoke about this yesterday. The increases to the national living wage, I mean, the impact of that on business is potentially huge, isn't it? But was there a lack of balance at the other side, and what sort of impact will that have on businesses, especially SMEs, I guess?
Well, I suppose that, you know, the thing that we're hearing all the time from our clients, you know, particularly in, you know, hospitality and the care sector is that just balancing the books right now with getting staff and then staff costs, you know, it's incredibly tricky balance. So, you know, those marginal increases in you know, national living wage, national minimum wage, you know, they do have ramifications. And although there was a lot of announcements yesterday about the social care sector and potential money coming down the tubes and grants, you know, it remains to be seen whether the books are balanced for those individual businesses.
Yeah, it's a tough one for businesses. It's a tough one politically as well, isn't it? If they hadn't have gone up, they would have got a kick in over that. Well, listen, it's been a great great back and forth, a really great chat and really insightful. So thank you guys. I'm going to pass back to Mark to say a few more words before we wrap up. Mark.
Thank you, Richard, and yes, thank you to your team as well at Archam for the support this morning. Obviously, thank you very much to Colin and Mary. You did well there, I think, to guide us through the key aspects of the changes announced yesterday. So thank you, and thanks to everyone for joining us today. I hope you enjoy the rest of your day. Goodbye.
Thank you very much, guys. Have a nice weekend.